we had an anchor investor. They were going to anchor with $40. It's a large family office, multi-billion. They're like, wow, you guys are really smart. We're really smart as well. That's why we want to invest with you. And you know who else is really smart? Gabe Plotkin of Melvin Capital. You ever met that guy? You should really talk to Gabe. He's our largest allocation. So we're waiting for that ticket. We're targeting a February of 21 launch date. Well, a little thing happened in January of 21, just before we intended to launch. GameStop blows Melvin up. These guys get a hole ripped in their balance sheet also as a result of Melvin. And then they're like, yeah, about that $40 ticket. No, we don't think activist short selling is a great idea anymore.
Hello, everyone. Welcome to the first episode of Other People's Money, the podcast where we talk about the business of the fund management industry. I'm joined today by CIO and founder of Muddy Waters Capital, Carson Block. Carson, thank you so much for coming on and being the first guest.
I'm glad to be here, Max. Thanks for inviting me.
Before we get started, I just wanted to do a quick disclaimer. Nothing we say here is investment advice or is marketing or advertising for Muddy Waters or any of their funds. This entire conversation is meant to be educational and informative for people to learn about the fund management industry. There's plenty of market podcasts out there where the guest is having their feet held to the fire about where the S&P 500 is going to end, what the next big trade is. That's not really what this show is about. I'm really much more interested in talking to business owners, founders like yourself about what it's like to actually run a fund management business. Obviously, talking about the market, talking about your strategy is highly relevant to answering that question holistically. So we will touch on a little bit, but it's really about the business of being a fund manager. So why don't we go back to the beginning, to before you were a fund manager? How did you start out your career? And then we'll get to Muddy Waters.
So I actually started my career on the long side, and I started investing as a kid because my father was an equity analyst, and he did long side investments only. He focused on microcaps. So I began editing or wordsmithing his reports probably seventh grade or so. And I think that was around the time also I began working usually for him summers on Wall Street. So when I was in middle school and high school, I'd be going into the city with him almost every day. And yeah, I continued investing, working at investment firms in college. I got my Series 7 after my freshman year. I worked for a portfolio manager. So I had this long side investment orientation for a long time. But what ended up happening, I was, the few stops along the way after I graduated from college in 98. I was working with my father full time, 2000 to 2002 or 99 to 02. And we were staying away from all of these internet companies. We knew it was a bubble. None of it made sense to us. So we were looking for good growth at reasonable price companies in the microcap space. And it turns out that we were getting lied to routinely by these managements. And this is the same time that the largest public companies in the US are blowing up in their own scandals, like Enron and WorldCom and Health South, Adelphia, et cetera. So the market seemed riddled with liars from top to bottom. And that was a very disillusioning time for me. So that caused me to go to law school because I thought that the finance part was relatively easy compared to the whole how do I protect myself portion of investing. So that's really, and I didn't understand this at the time, but that set me on the path to becoming a short seller was I guess the skepticism and cynicism that my early career experiences imbued me with. And being in China, even though I wasn't doing anything initially in the investment industry. First, I was a lawyer at Jones Day, and then I started the first self storage business in mainland China. But I saw how easily perception is manipulated, and I saw how the Chinese will question the most basic assumptions. Like experienced Chinese business person tours a factory, does not assume that the person who's says he owns the factory is actually the owner, or that the name on the sign is the name that's going to be there on that sign tomorrow after he's gone. So you learn in China in business, if you're going to stay afloat, to ask the most basic questions. And I started this business, not the fund management portion, but the activist short selling business by accident, really, in 2010. My father was really excited about a number of these Chinese companies that had listed in the US via reverse merger. And he was particularly excited about one called Orient Paper, which just make that brown wavy paper that goes inside corrugated cardboard. If you ever look at a cross section of it, I mean, can't imagine a more boring commoditized business. But the numbers showed they were growing top line at like 60% a year and had these high margins. And yeah, he asked me to take a look at it, and I every other domino had fallen for me in the public markets in terms of who I didn't trust. But this would be the last domino, because up until that moment in time, I had assumed wrongly, as do probably 99 point something percent of investors, that auditors are there to perform an anti-fraud function. Like that is literally not what they do. But this company that would soon have an unqualified audit opinion, and reported $103 million in revenue for 2009. I mean, the real number was about 2.5 or $3 million. So put together a report exposing that, not really knowing why I was doing it, but I guess one of the life lessons there is my self storage business was going nowhere. And because we were in the global financial crisis by that time, and so China had jammed so much money into the banking system that real estate prices had ripped. I couldn't expand the business as a result. So I was pretty much trapped in that business. And there's a power in feeling like you have nothing to lose. So I had this company that was a fraud. If I felt like I had something to lose, business wise anyway, I good chance I never would have done anything. But I figured, fuck it, I'm going to throw the ball as far down the field as I can, and see what happens. And so I put this report together. It went viral. And 1 year later, Bloomberg named me one of the 50 most influential in global finance, along with like Ben Bernanke and Jamie Dimon, Warren Buffett. So it
What
was like winning the lottery. And
what was the
that's
market cap of Orient Paper at the time that you published?
It was 150 million, which, in today's terms would be equivalent to probably about like 800 million, given what's happened, the inflation of equity values. But yeah, it was 150 million.
Okay, wow. So you published the report. Did you publish anything else within that year? How quickly did you go from, okay, this just happened because my dad was interested in this company, to how do I find more of these and start putting out more reports? When did it become, something you've stumbled upon, to a hobby probably, and then to a business?
Well, it I mean, everything happened really fast. So I put that report out. I sent it to maybe 50 people in the market, most of whom I hadn't spoken with any more recently than 9 or 10 years earlier. The vast majority of them, probably to the extent they did remember me, would have remembered me as Bill Block's son. So I did that on June 28th, 2010, shortly before the close, and the stock ticked down a little bit toward the end. I mean, I put the report out at about 3 p.m. New York time, and I was in Shanghai at the time, and so I just went to bed. I was exhausted. Next night, the stock opened and it cratered, and at one point it was down 55%. And so that's when the company came back with, no, this is all lies. Carson Block and his father had tried to extort money from us, and we said no, and this is revenge. And the death threats started coming in. CNBC, Jim Cramer's like screaming my name about how I sound like I'm the fraud, dude I've never met, or at that time had never met. And but I also got a bunch of emails coming in from smart money investors, hedge funds that were basically saying, hey, congratulations on proving one of these things is a fraud. They're all frauds. Have you ever looked at ABC? And so I just started cracking open 10Ks. And I had thought that Orient Paper was this singular distortion. But no, I'm reading these other 10Ks. And by that point, I can see the matrix. Like I'd already known from Orient Paper's filings when I started reading them just before the site visit in early 2010. I'd already, like from the filings, I could tell something was way off. The site visit confirmed that it was, I guess, at the very outer limits of my imagination as to how off things were. But but yeah, just reading through these 10Ks, things were all obviously frauds if you know what goes on and how business works in China, how the legal system works in China. So it then became a sprint to publish as many on these things as quickly as possible. I was basically broke at that time, but after that first Orient Paper report, a lot of these outreaches were people saying, hey, we'd love to find a way to make money with you, because I was going back and forth at that point with Orient Paper. They would put out a press release, Carson Block's a liar. Here are our real onshore Chinese numbers, which were obviously, they bribed somebody to be able to retroactively change the numbers. And I had the original filings that I'm like, posting. And, so the stock would go up on, their response. It would go back down on, my response to their response, so on and so forth. And so I had a lot of people reach out, and I said to these people right up front, I said, look, I got to imagine that at some point the SEC is looking at this, because frankly, I want them to look over here. This company is a fraud, and a bunch of these other companies are frauds. So it'd be great to get SEC attention. So if your goal in life, or if one of them is to never have a conversation with the SEC, there's probably no reason for us to continue speaking. So that ended a lot of conversations, but there were a handful of people who were still interested in somehow providing capital and profiting from what I was doing. And some of them were pretty sophisticated about the China to US fraud cap space.
I think that opens up an interesting line of questioning about this business of publishing for other funds. I think obviously now people understand what you do. You have a fund, you take positions in the names that you write about. But there was a period of time when you didn't have a fund. So, it became a business, but what did that business look like? How were you making money?
Well, okay, so I would like to go back to that moment right after Orient Paper and before the next thing on which we published, when I was having all these conversations, because some of the conversations were, gee, you're really smart at this. How about you just do subscription research, and we'll be your exclusive subscriber. We'll pay you $250,000 an idea, provided that it meets these criteria and you don't publish it anywhere else. And then there were other funds. So that was an offer that I got from a particularly large, well-known long short fund. Then there were other funds that said, hey, if we were one of 5 subscribers, then, that would be great, but we wouldn't want you talking about this stuff publicly. So I had, I could see, and compared to, well, I mean, to me at the time, they were talking real money, right? Like, I'm like, wow, I could make $1 million a year. Granted that I just incinerated money for the previous, few years. That was like that represented, or would have represented, a massive, you know, life changing
Yeah.
income. But by the same token, it wasn't satisfying, because I thought, well, does it really matter if I'm telling people that these things are frauds and nobody's saying it out loud? Like, how does this end up making anybody any money? How sustainable a business is that really? And PS, is that what I'm on this earth here to do? Is to quietly tell people that these companies are fucked up and and try to keep it like a small secret? So it didn't settle well. That idea didn't sit well with me in either count. So I realized, hey, if I could get some capital, we could take positions ahead of publication, buy, I mean, back in those days it was like buy a bunch of put options, publish, and take most of the money off the table and do the battle and go on to the next one. And so the next one was a company called Rhino International, 90% plus fraud. And the company actually screwed up. Like the chairman or the CEO screwed up and had a conversation with his auditor right after we published, in which he admitted that a good portion of the contracts, quote, had problems, and auditor forced them to put out an 8K. Stock was halted, delisted soon thereafter, and that was really important to building my reputation, and just went on for a few more names until we got to Sinoforce in June of 2011. And that was one where John Paulson was along that, and he'd become this kind of hero of the
Yeah.
financial crisis. So the amount of reputational boost I received from the Sinoforce call, or Muddy Waters received from that, was massive. And that was a life-changing amount of money. So at that point in time, as a group, Muddy Waters, we were trading our own capital in these names. We also, from most of these publications, had what we would later come to call a balance sheet provider. So a fund that had significant capital, had complete connectivity, so they could borrow, they could short different markets. And we ran with that until about 2013. In 2013, for the most part, we went to strictly internal capital. The exception there was when we just couldn't get borrow. So if we were doing something in an overseas market, we'd been using interactive brokers, which for a retail product is great, but it's when you're short selling, you really need to be institutional. You need to have multiple counterparties. You need to be able to talk to the borrow desk to get color on how stable the borrow is, or if it's if they're scrapping it together from different locations, and to negotiate rates at times and see if you can term it up. It's just, short selling is just not a business that maps well at all to retail connectivity. As great as interactive brokers is. So there was that impetus to launch a fund, in the background the whole time, this need to have institutional connectivity. But it's a chicken or egg problem, right? Like you can't get that institutional connectivity, especially multiple counterparties, unless you have real AUM.
Had you received interest from investors? Had people tapped you before and said, "Have you considered building a product around this?" Or did you build the product first before you really knew whether there were buyers?
Well, in 2010 or 11, so the party who would become our initial balance sheet provider, that principal, because I said initially, hey, I want to do this as a fund. So he's like, all right, fine, I'll give you $10. I was able to get commitments for $5 from some other places. So I'm like, wow, okay, 15 million out the gate. Then I, learned how much it cost to, set up an entity in Cayman, and the Cayman legal fees. And these were offshore investors, so they didn't want to go through a U.S. entity. And then I started talking to primes. Well, pretty much everybody said, "Go fuck yourself," right? Because like I needed to prime with pretty primes who had access to borrow, but we were way too small. But then they have these introducing primes or mini primes. Um, like Cantor was one, and they introduced to Goldman. BTIG. I didn't talk to BTIG back then, but talking to some of these mini primes, when they talked to the bulge bracket primes, I mean, that was the response. Because I was an activist short seller. Go fuck yourselves. Like, no interest in doing this. So That crushed in 2010, late 10, early 11. That crushed my aspirations of launching a fund. And so we had to go with that balance sheet provider approach. And then, like I said, in 2013, it was mostly internal capital. And then I presented in November of 2014 at Sohn London, and there was an allocator in the audience, and they were a larger allocator for, for that audience. And so they were at the speakers dinner afterward, and, they said, love what you do. What would you think about, if we say, gave you $100, would you manage that? Like, well, yes, that's somewhat interesting, of course.
Mhm.
Then but I was like, so here's how I would do it. I would say we'd run like 50% net short, and we'd have this basket of, and they're just like, no, 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 no. Listen, I don't think that's what you want to do. I don't think you want to be the guy, or one of these guys who has to follow dozens of companies and be on all these earnings calls. What you do is you do intensive deep dive research. You're passionate about it. You communicate it. Your passion comes through in those communications. You're an animal with that. That's what we want. And that was cool because it was a bit of I was pretending, right? When I was like, yeah, we'll do 50% net short most of the time,
You were you were
we'll have
trying to
this.
give them what you thought they wanted.
Yeah. And you know what? Like, honestly, God bless them for knowing that's not really who I am anyway and not who I wanted to be. Um, so that was a much needed moment of honesty. And that's what got us into the fund management business. But, and very few people who go into fund management have the serendipity of having somebody hand them $100 before they ever started marketing. But I'll tell you, I mean, and that was in 2015, end of 15 that we launched. So it took about a year
Yeah.
from then to get everything ready and to launch. But it was yeah, I mean, it was barely I mean, it wasn't really an economic business. With what I do, and even now we manage in short activist products, yeah, north of 200 million, but it's like not really the economics of this business are pretty hard scrabble, and I'm
So
sure we'll get into them.
yeah, so I was gonna say when you took that initial 100, usually with a big cedar like that, they're gonna extract their pound of flesh from the GP. Did they
It was not a seed deal. No, they
Okay,
were an anchor investor. We set up a fund of one. I mean, what they got concessions on fees,
okay.
better fees than we would get for our subsequent pooled vehicles, and also better fees than if I were working with a balance sheet provider. Like, my market at that time was I probably would get 35% payouts from balance sheet providers. Whereas we were getting, I think, 22 and a half from our anchor investor.
I know just from talking to you in the past that you do run a pretty high fee structure compared to a lot of people in the business. So, did that happen initially that you had that higher management fee because of the depth of the research and the level of confidence that you need to have both legally and on the thesis before you go out there with something? I mean, was that understood by that initial investor group?
Yeah. So, okay. So basically, I made some mistakes, not necessarily with that anchor investor, but when we then, so I think we launched that fund with them November 15, August of 16 is when we launched our first, truly pooled vehicle. And, we had some family offices, funds of funds, UHNWs. And we went out with a 2.5 and 30 fee structure. And the thing there was we were saying, hey, look, this is a clean 2.5 because the old axiom had been 2 and 20, but the two was under significant pressure in long short equities. So effectively, from I think most long short managers in equities are probably getting a 1.5, maybe 1.25 today. But so we were definitely, it looked above market. so part of this was saying, well, this is a boutique strategy. It's not that scalable. But we were also saying it's a clean structure. We're not doing pass throughs on top of this. And that was a mistake because we should have done pass throughs. And look, if the trade off would have been doing, nominally two plus pass throughs, yeah, we should have done that. But I hadn't the way I had been running the business before having any outside capital was it was it's like 99 out of 100 days, almost literally that, I'm losing money, right? I have expenses. And then several times a year, somewhere between 2 and 5 times a year, we put on a trade, and those trades usually made money. But I had depended on those few events per year to basically, repay me for all the money I was burning in between the trades. So when I had some management fee income, it was like, oh wow, I can take this quarterly. And so I didn't really, I didn't really understand what my cost base was going to be. I mean, you take outside capital, you automatically have a higher cost base than we did before, just because now you've got all these regulatory requirements. We have a COO, which we didn't have before, an additional cost burden. So I would say honestly, it took I broke even versus what I'd been doing as just a short activist, with internal capital or balance sheet provider. I was making the same amount of money for about 3 or 4 years once we had outside capital. And in some ways it was less work. In some ways it was more work. It was less work in the sense that with the COO, I no longer had to do just all the annoying little things of the business, like deal with telecom providers and figure out how to order the computers and deal with AT&T for our cell phones. Somebody was doing that. But on the other hand, there were just, again, because we're regulated, there were so many more moving parts. And so there were more things that got pushed on my plate. So yeah, for a few years, I was there asking myself, putting aside the questions of connectivity, which we had obviously solved the connectivity problems, but not without a lot of drama. Like, we'd been kicked out by a couple of primes who we were once with along the way, much to my consternation. And even today, I'm just fucking furious about that. But we still had far better connectivity then. So that's what I told myself, 3 or 4 years down the line. I'm like, well, I'm making the same amount of money, probably the same overall level of bullshit. It's just slightly different forms of bullshit. Um, but at least we have connectivity. And then we were able to grow the business and start doing some things that were more interesting. And we became balance sheet providers. Really, I think starting at the end of 2016, balance sheet providers to other short activists. So that was the moment at which I started making somewhat more money than I had on a standalone basis.
And so the balance sheet provider business allows you essentially to publish more frequently because you can only do so much research that's high enough quality to be worthy of going out. And is that really the benefit of being the balance sheet provider?
Not to publish more frequently, but to trade more frequently. So a lot of people misunderstand the activist short selling model, and they criticize it, right? So the traditional way you do it, whether you're managing outside capital or it's your own money, or you've got a balance sheet provider, is you basically you're going to publish the report, so you have your date on which you're going to release it, and you get risked to the gills, I mean, relative to the liquidity of the stock itself. So but you basically put as much risk on as you think the liquidity of that stock merits. You go public, and the volume should spike.
Yeah, I was gonna say, is
And
that liquidity going into it or the liquidity that you think will be there because you know that there's gonna be more?
Right. I mean, you assume some multiple of average daily volume on your release, and it has to do with the market, has to do with the market cap. Um, Also, if you can use the F word, fraud, you're going to get more volume. So you have to make some assumptions about the multiple of average daily volume. You should tend to the conservative post release of, or immediately post release of the report, and the volume usually stays elevated. I'd say day two. So if day one is the date the report comes out, day two the volume is usually about half of day one, and then by day four it kind of normalizes. But the thing that was always tricky, and it's probably changed over time, but a lot of the volume, when you see the volume spikes, like how much of it is real volume, how much of it is natural sellers versus algos just like trading back and forth with each other. So you have to be, the idea is to you have to be able to cover your positions, because you've got this massive position in terms of risk relative to your capital base. Usually, like that's the problem. Like, you cannot hold that, because you could quickly be out of business, and maybe even personally BK if you didn't de-risk. So the thing is, because short activism, when done right, is takes so much focus and so much attention to detail, you can't pump these out that frequently. I mean, I've long felt that our maximum capacity as a firm, I mean, if we fired on all cylinders for the whole year, we would do 6 of these. And I don't think we've hit 6 like in probably over a decade, right? So we're probably, our cadence is maybe more 4 to 5. And no, I mean, you could look at Nate Anderson of Hindenburg, doesn't manage money. Nate, I think, is probably just a better manager than I am, in terms of how to run a business and make sure that the gears are greased, so to speak. So he can do more, but we are where we are. But whatever it is, it's a relatively small number of trades. You have to swing big at each one, because that's how you get paid. Well, when we went into the balance sheet provision business, we work with a handful of short activists at any given time. So that took our normal annual trade number of trades from, call it 4 to 5, to, I don't know, maybe a total of 30 in a given year. 25 to 30, give or take. And so that then enabled us to create, to as a strategy, to initiate positions with lower concentration levels. So we're not, trying to push it as much as we can relative to the liquidity of the stock, and even, I mean, look, there have been times when we've been beyond 100% of capital short a name. But when we're able to see, say, 25, 30 trades a year, then we could do something where we're more, about 10% of capital, and we hold the positions for months, and we're not super worried about the liquidity. It's really a function of our percentage of capital. So that changed the game for us, in terms of how we can trade and manage risk. Now, unfortunately, when when we came up with this idea, probably late 2018, we said, hey, this now is doable for us because of our balance sheet business. And when you look at the medium to long term performances of the names that we've shorted, that a lot of these other short activists, the guys to whom we're providing balance sheet, when you look at that, there's a lot more money to be made if we hold the positions. And again, that's what, like, all the critics say, well, if you really believe, why don't you hold the
Hold it to
position?
zero.
Yeah, or at least so. And again, I think I hopefully just answered for everybody, like, why you can't do that when you're just doing your own, like, again, you're publishing a handful of times per year. But so when we started talking about that with our LPs, I mean, we got a bad reaction from LPs. It was, yeah, great. I appreciate that we can make more money, but you know what? I like the low vol. I'm happy with the lower returns, lower vol profile. And that was not something we expected. We thought everybody would be like, great. So we were still kind of trapped in that trading and risk management
So
mold.
before the balance sheet, you must have been flat most months, just essentially almost completely flat, except for around when you published.
Yeah, yeah, that's generally the way it was. I mean, like, obviously our management fees would get charged, and
Yeah.
tag performance, but and there we had some. Look, we kept residual positions on, so there was some, there was some movement in the book, but yeah, by and large, I mean, traditional short activist, the way you trade it is, you make or don't make your money on your days one. Um, so, we felt we had another way of doing this and of making more money. But LPs were generally, some were supportive, but they generally were not supportive, or even the ones who were supportive weren't that supportive. So again, we had that idea in 2018. Um, and what I then said was, okay, look, we're going to have to do this as a separate fund, because that's what we're hearing from our LPs. I said, so if we create a separate fund, the problem is we haven't run risk in this way before. We haven't kept short positions on for a long time. And the biggest issue, at least internally, like this is what we knew. Our issue was going to be that we were going to cover too soon rather than too late. Because again, like that's how we've been conditioned by that traditional short activist trading strategy. And just me, even when I was on the long side, like I took profits often way too soon, because I was like, hey, this is, like, why look a gift horse in the mouth? The stock's up, 40% in the past 6 weeks. I don't care, if you think it can run more, this is awesome. And I would take money off. So that had been my own personal issue on the long side. So we were looking at a similar problem on the short side. So we said, okay, look, we need to have a rules-based system for when we're going to cover. And so we did regression, like in-house, we did basic regression analyses on, if there's an ideal period of time, post-report, or looking at a few other variables. And, of course, the real world is not nearly that easy and clean, right? There was no way to come up with a good rule. So then we said, okay, you know what? Let's bring in some data scientists and see if they can create, an algorithm or a series of algorithms that can advise us on when to close, because I want to guard against closing too early. And I said, more pragmatically, from a marketing perspective, when we go out and try to market this fund that's going to have a different risk and holding profile, I think a lot of potential investors will say, well, I'm skeptical you can run risk this way, and because they always had a lot of allocators seem to have some view, at least back then, that good short sellers had a feel for the market and for, when was the time to cover. And I really don't believe that's been the case, at least since the financial crisis. But yeah, the time to cover is before you put the trade on, in the short world
It's
since
to go
then.
long. The time to cover
Yeah,
is to go long in the first
exactly.
place. Yeah.
Exactly. Yeah. But so we got these data scientists involved. They built this thing, and it when we back tested it, it really did seem to work, and and it advised well, and we were happy with it. I said, all right, well, now we need to give it a cool like acronym that's a female name, kind of like a hot female name. So we called it Lana, which I, think's logic and numerical analysis or some shit like that. But and then we went out and tried to market it. And then COVID hit. And that that was such a hard period of time. We did okay in our initial, we still only had that one short activist fund. We did okay in 2020, but we really didn't get around to being able to try to market this product, which until the end of 2020. And we had an anchor investor. They were going to anchor with $40, and it was pretty funny because, well, I look back on it and laugh, but we started talking to them the summer of 2020. It was a large family office, multi-billion. And, they're like, wow, you guys are really smart. We're really smart as well. That's why we want to invest with you. And you know who else is really smart? Gabe Plotkin of Melvin Capital. You ever met that guy? You should really talk to Gabe. He's our largest allocation. He's smart. You're smart. We're smart. Let's all be smart together. So, okay, whatever. Right. So we're waiting for that ticket. We're targeting a February of 21 launch date. Well, a little thing happened in January of 21, just before we intended to launch, happened to Melvin, and to these guys as a result, GameStop. So GameStop blows Melvin up. These guys get a hole ripped in their balance sheet also as a result of Melvin. And then they're like, yeah, about that $40 ticket. No, we don't think activist short selling is a great idea anymore. And they ended up giving more money to Melvin, which got incinerated. I guess I'm happy to say. But yeah, so we launched that product. I mean, it was a really disappointing number, and like we've gotten it bigger, but anyway, yeah, that was that's been our journey with the short activist products.
So that obviously I'm not looking for names or anything like that, but that first allocator came to you. They said they really like what you do. You came this other one. Clearly, they were in Melbourne already. They like the short world. When you think about the types of people who are buying these products, is it a varied group of people? Do they fit an archetype? I think when you look at the allocators to, these ultra large hedge funds, the multi-manager platforms, I'm sure you've got all different types of allocators that have varying profiles. For a more niche product like you, are you marketing to a minority of LPs, or do you find that it actually is varied, the type of people who want something this niche?
Well, so I mean, look, these products are not scalable. So at one point we got our, in 2020, I think it was early 2020, we got our that initial fund, itself was up, I think maybe to about 250 million. And it was just cumbersome, and I felt like the tail was wagging the dog at times where, we were almost on our research process. There was definitely a tug of, from well, maybe we should start by looking for liquid names and then find dysfunction, whereas the idea had always been like, let's look for dysfunction. um, and so when I started feeling that tension, we said, hey, we've got to do a partial redemption. And so we did a partial redemption, and I think we'd been hard closed at that point anyway for a little while. So when you think about really how much capacity this strategy has, and look, there's a guy out there who's got an activist short fund. He runs a decent bit more than that now. I really don't like the way he generates his returns. He seems to generate his returns by just slamming stocks on the way in, and then hoping he gets out on day one, more or less break even with the previous close. Um, I mean, like, we're not going to do that. Like, I'm not going to do that. So if you're not going to do that, there's a limit to how much
So
AUM you can
when you
have.
say that, you mean that just getting short, building up the position, the stock is down
Yeah.
20% before the report's even out?
I mean, when you see the charts of, of this firm's, short activist names, I don't think I mean, these are bigger names. They don't sell off 20% in a few days beforehand, but I mean, they'll trade down like, I don't know, like 5 to 8% in a few days uh, ahead of the release. So, and then a lot of times the day of, they get a volume spike, but by the close of that day, it's often not the greatest, result. So, my opinion based on those facts is that the idea there is to really make the money on the way in. And, that's exactly the kind of shit that our industry, the short activist industry, is accused of doing. And there are very few people, maybe nobody else, who operates that way. So, I mean, look, something that's long gotten under my skin is I feel like as one of the higher profile activist short sellers, we get painted with the sins of the people who aren't doing it the right way. So if you're not going to operate that way, there is a limit to how much capital you can have. So we cannot take $200 checks. And I wouldn't want to a single investor with 100 million again either. because it's just too much concentration. That person pulls and your lights out, or it takes you a long time to cobble together, a handful of investors to replace it. So
You just
you
hired some
definitely want,
analysts that you have to say, "Hey, thanks for moving to Austin, but we're gonna have to let you go."
yeah,
Yeah.
exactly. And so look, they're given that profile. Okay, if you accept that, the upper limit in a day one type of fund, and we swing a bigger bat than most in the short activist space, right? So if you're not able to get traction with mid cap companies the way that Muddy Waters is, you can't even handle the kind of numbers of AUM that we are, and it's likely non-economic for you to have a fund management business, which is why you then look for a balance sheet provider like us. But especially because the running costs of a short activist fund management business should be a decent bit higher than if you were just doing, long short equities and you weren't taking the risk of saying mean things out loud. But yeah, I mean, when you look at that, it's a capital constrained business. So the core investors are small to mid-sized family offices, um, funds of funds, and smaller university endowments. That you're not, there's no conversation to be had with a sovereign wealth fund, or with a large pension system. I mean, it's just the you'd be subsumed by that ticket size.
Obviously, the family offices, I mean, some of those, they resemble like ultra high net worth, like whether you
Hmm.
choose to institutionalize your personal money, as a choice at a certain level of wealth. But those small endowments, that, I mean, that's got to be an interesting phone call when you get an endowment that's interested in you compared to these ultra high net worth people. Is there anything in particular about them?
Well, in the early days, and especially our day one investor, I mean, they were really worried about headline risk. Like, oh, what if it comes out that XYZ University is the backer of Muddy Waters? And we when we did like one of our early post raising a fund, one of our earlier really controversial shorts was St. Jude Medical. This is not the Children's Hospital. Okay, we never shorted kids with cancer. Um, but they made, now owned by Abbott, but they were in the process of being acquired by Abbott, and St. Jude made these implantable medical devices, pacemakers, and defibrillators. And there were serious cybersecurity issues with them that have been brought to our attention. So that was the short. It was, hey, and look, there was, look, I've long been, by that point in time, I'd spent years being a target for Chinese state-sponsored hacking, other, intrusion attempts as well, to figure out what we were working on. So cybersecurity was something that I took almost personally, or I viewed as a personal affront, how little companies cared about it. And they still do care nothing about it, right? I mean, to be fair, nobody pays more for a product, or software product, because it's more secure than the competition.
I get 2 letters a year letting me know that my personal data has been lost in this hack, and there's nothing I can do about it.
Yeah, exactly. And so companies figure, look, hopefully the roulette wheel, the ball won't land on our square, it'll be somebody else's square, and we're just not going to really care that much about cybersecurity. So and I felt that that had been probably the culture at St. Jude with respect to these devices, which connected wirelessly to information monitoring systems. So we were getting ready to short that, and like, that was controversial because we need to make it we needed to make it clear, um, that we were not giving away the formula, like how you actually hack it. We were merely showing that it was hackable. And so that there was real concern about headline risk for our day one university endowment investor. We assuaged those concerns, but but yeah, they were, initially they were really, like, whoa, I'm not sure we signed up for this. So that was an early day issue. These days, I don't know. There was obviously the big DOJ SEC investigation in the space. Well known that we got put through the ringer, and at least the SEC gave us a letter saying that it wasn't going to take any. They were recommending no action be taken. It did indict Andrew Left, and the SEC separately filed a civil complaint against him as well. I do think that those actions have significant legal and even factual issues, but that maybe has cast a bit of a pall over the space in terms of fundraising. Those of us who have funds in the space, I mean, it seems like we all have pretty much the same LPs, to tell you the truth. So I don't know if it's because none of us have really tried to market in recent years outside of this group of investors, but it's more or less the same, the same institutions that allocate in the space to everybody at present.
Okay. Do you think that's personality, or do you think it's because they understand the business and there's so many, preconceived notions? Is it that they get it or that they like it?
Well, yeah, some of them understand the business better than others. I mean, when we see some of these, when we see some of the allocations that certain LPs have made to new activist investors or short activist investors or others who've been around, um, sometimes we think, man, you really don't understand the business, um, or you don't really care about quality. But I think they just don't worry about the reputation risk. They're comfortable with it from, hey, we get what these guys do. We don't think it's going to be a problem for us, or our investors. But yeah, I think for a lot of investors, they don't quite, they're just not comfortable with that profile, or just that notion of calling out companies publicly.
The activist product is what you're known for. Then there's the one where you're holding these names longer, more of a traditional, market neutral long short strategy. But you've branched out into other strategies that still touch on this core competency. What is it that has led you to branch out into more strategies and think about expanding Muddy Waters business?
Sure. Well, one thing I'll also say, I mean, it's been hard to branch out into these other strategies and launch these funds, at least with respect to our existing LPs, because it's funny, just kind of going back to what they understand or believe about short activism. You get the impression that for a lot of these LPs, they don't think that there are transferable skills from short activism to other aspects of investing, and we have these conversations with them, like, we're asking, what, you don't think that doing in-depth research can provide an edge elsewhere, or having the ability to communicate provides an edge, having sophisticated understanding of structures and legal issues. But anyway, so the answer is, at least based on actions and inactions, a lot of the short activist LPs, kind of think that that we only have one, that we're like one trick ponies, basically. And I disagree, but then again, I think a lot of us, our own opinions of ourselves might differ from those of the people around us. But the first effort that we really got into was, it led to the launch of a fund that's focused on long investing in Vietnam, which we call the Muddy Waters New World Order Fund. And what happened there, as we covered, I got my start in China, shorting these Chinese names, and I've lived a total of 6 years in China. And as of 2007, I was really amazed by what I thought were all these open secret, or open to me but secret from the rest of the world, about how China really works. And I just kind of was wondering, like, when will the rest of the world catch on? Well, 2016, Trump is elected. a lot of rhetoric. He really moved the needle, I think, in American society and business in terms of opening people's eyes or causing people's eyes to be open anyway to much more of the, I'd say the what I had long said is an undeclared economic war on the West by China. So more and more people started to view it that way. But I noted towards the end of 2017, it was kind of anomalous that while a lot of the bilateral trading and business relationships with China were underwater, seemingly in the finance sector, the links were strong and everybody wanted to like put money into China still. And so I've been waiting for that to break. So COVID came along, and in early April of 2020, I read a column in I think it was Washington Post by a journalist named Josh Rogan, and Josh, you know, I had come to know Josh personally, and Josh broke this news about how in the Wuhan Institute of Virology, which was studying bat coronaviruses, two previous State Department delegations had cabled back to the US that they had concerns about the biosecurity of that facility. And look, that didn't surprise me at all because I've long, joked, and probably not many people get this reference, but when I was growing up, Ford's slogan used to be Ford, where quality is job one. Well, I'd long said China, where quality is job done. And so, I could immediately believe, especially given China's cover up of COVID, that this came from a lab. And so then that led me to think about what the aftermath of COVID would look like. And, the world was kind of on fire at that moment in time in April of 2020. And I thought, you know what? Coming out of this, our corrupt elites who are bought off by multinationals are not going to be able to contain the anger. There will be such a swell of grassroots disgust with China that things are going to have to change politically. And this will be the biggest geopolitical realignment since World War II. And it's all going to revolve around China and how countries relate to China. So, and by the way, like pat on the back, I think that everything that's unfolded since ratifies that. But the question was, what's the trade? So we initially started looking for things on the short side. Could this be like, the big short in the financial crisis? And the answer was no, because it was too hard to understand which dominoes would fall and when they would fall. And even if knew which, but you didn't know when, that makes it not shortable. Unfortunately, we don't live in this world awash with this like almost, free risk that you can put on, in the form of CDS.
With the benefit of hindsight, it's very clear that they still had to like let it fall through. If you look at the property bubble that burst, that it became policy that, hey, we actually do need to let this thing unwind.
Look, that's interesting because look, for years, China's policymakers had recognized that there was this enormous fixed asset bubble, especially in real estate, and they occasionally implemented measures to try to gently let the air out of it, only to then, see the real data, and they looked into the abyss and said, "Fuck this, let's kick the can down the road." So COVID, and I wouldn't like I did not foresee this. In hindsight, it's foreseeable, but when you look at how China pursued this purported zero COVID policy, probably far longer than any other country on earth, at least far longer than any country that matters. Um, my interpretation of that was it was about establishing um, control of the population, and that enabled Xi to do enables him potentially to do two things. But the first thing was to burst the fixed asset bubble for real, right? So when you had all these Chinese people like cowering in their homes as people in bunny suits literally broke the locks on their apartments, burst through the door. People, wealthy, well off people in Chinese cities, tier one cities, are starving and they can't get food. And the government's response was, try to do anything about it and we'll kill you or we'll imprison you. And so that is establishing that level of fear and dominance over the population as a result of COVID has enabled Xi to say, we're going to do this for real now. So over the very long term, that's a good thing for the Chinese economy. It needs to rebalance. There's going to be so much pain between now and then. And of course, now, maybe even Xi's thinking it went too far and they're trying to reinflate it a little bit. But the second thing it might enable Xi to do is start a war over Taiwan. But getting back to that moment in time, we didn't have a short trade, so it was like, all right, well, what's the long side? And it was clear that FDI that would have gone to China is going to flow elsewhere. And the primary, I mean, I shouldn't say the primary, but I think the largest single beneficiary of the redirection of FDI flows relative to the size of its economy and its markets is Vietnam. And we looked at, well, do you play that in the private space? No, not really. I mean, at least in venture, you can't get enough scale from a company in Vietnam for the most part to make it a real viable investment. But it had this public equities market. And a lot of the company, or I shouldn't say a lot, but there are a number of companies that are investable. And the other thing to us, the coup de grace, is that the legal system is very similar. The legal and governance system of the country is very similar to that of China. And it's an environment in which, China is obviously an environment in which we're very comfortable operating. We know how to get information and, really dig below the surface. And so our belief is that a lot of that is transferable to Vietnam. And so the idea is that a rising tide there, I'm not going to say it'll lift all boats because it's a frontier market. Even as an EM, there are obviously going to be boats that you wouldn't want to get in. But if you can X out the boats you really don't want to get in and maybe identify the ones you really do want to be in, well, then you ride that rising tide. So we opened an office in Vietnam about 3 years ago. We hired somebody who'd been in our world, the short selling world. His name is Rob Med. He had a short-oriented research firm out of Hong Kong prior to working with us. And he'd been living in Asia and Hong Kong for about 20, I think close to 25 years. So he's not naive. He's not a newbie. He doesn't drink the Kool-Aid. And philosophically very well aligned with us. So he moved to Vietnam in late 21. And we went through this cycle where, you start going through the companies that foreigners typically traffic in, and you're like, no, that's got these problems. And so we got to this point where we said, okay, we are comfortable now that we know what not to touch and we know where there's real value. And the thing is, most of our competition in Vietnam, they manage a lot more money than we have ambitions to manage. So, similar to short activism, where you have this liquidity problem that caps your AUM. So, yeah, we don't want to have more than, a handful of $100 million of AUM in Vietnam because we think there are really interesting off the run long side opportunities there if you're not managing too much money. So if you start managing, above a certain amount, then you have to go a little bit more, you have to start looking a little bit more like the index. So that's our that's our raison d'etre for Vietnam. Um, Now, the other thing we've gone into is we say resources now instead of mining because it's not oil and gas, but it's metals mining. But when we say mining to people, everybody's like, "Oh, you're in crypto too?" Which no, we are not. Don't talk to me about crypto. But so metals mining, and the way this came about in 2017, we shorted a Canadian listed junior miner called Asanko Gold. And I think we did great work on that. But that was brought to us by a guy named Darren McLean, who was at a firm in Toronto. He was running a mining book there. And so Darren had already actually published negative research on Asanko, but he'd written it in a very technical way and it didn't get much traction. So came along to us. We didn't know him from a hole in the wall. We engaged independent geological or geologists as consultants. We verified the thesis. We did our own work, drone overflights and satellite imagery, and we published on it. And it was a really good short. Then about a year later, Darren came to us with something on the long side called GT Gold. Once again, we went to went to the consultants, the geologists. They thought it did have the potential to be a world class copper and gold mine, or copper mine, and we went long that. And Newmont ended up buying it. And up till that moment, I used to kind of deride long side investing, versus activist short selling, because I'm like, yeah, it's just making money. Like activist short selling, I feel a real sense of purpose. I got to tell you, making 5x your investment, that feels like a real sense of purpose to me, or at least it did at that moment. So, yeah, we did, so then we our relationship with Darren grew. He got us involved in a company called Mayfair Gold. We're in both GT Gold and Mayfair Gold were publicly disclosed as shareholders because we were and are above 10% respectively. Um, and then Darren ended up leaving K2, and we've launched a mining fund, mostly to do do mostly long side investments in junior miners. And Darren is an advisor to that fund. So that's something we've just launched, and we're really excited about that. So it's copper, gold, potentially other base metals as well.
And so do you, with Vietnam, I guess, you know, the idea of addition by subtraction makes a lot of sense where you're trying to take the names out of the index. Is that what you're doing on the mining side, or is it just that it is such a highly technical field that requires such individual research? Well, it's less about taking out the fraud because mining is known as kind of a fraudy sector, for lack of a better term. Um, but is it really just the research quality that you think you're able to do rather than, dodging the landmines?
Well, look, it's some of both. I mean, the research quality helps you dodge the landmines, but there are a few things here. At so the way that we look at investing in junior miners, you can get venture type returns from that, but you get a lot more data, a lot more information upon which to base your investing decisions than you do in venture. So if you know what you're doing, um, it can be great. The other thing is really, there are not many bright people who've graduated from university in the past 20-ish years and said, I want to go into mining, right? They've gone into finance and tech. And so there's been a tremendous under allocation of talent to the mining industry. And that's on both the operating side and the capital allocation side. So there's frankly a lot of mediocrity among operators, a lot of short termism. And so, our view is that, we can work constructively at times with companies to try to help them bring in additional people to help operate, but that we also can sort out the good operators from the bad operators. And again, like, we don't feel that there's a lot of competition in the allocation side here that would start to meaningfully erode edge. We think there's a lot of edge there if you're willing to do the work and you know how to do the work. Because so much of it is just guys like gathered in Toronto and Vancouver, trading on, quote, rumors, and often turn out to be true. So one of the funniest things, I mean, when you think of Canada, as you look at some of these stocks, a lot of these stocks will rip, a day or two before positive news is announced. That's not our game. But that's how a lot of people in the space approach mining. So yeah, at this point in time, we think there's just a lot of edge available for people who do deep research, and that's our whole purpose for being there.
Well, and the communication side of it too. I mean, it's often said derisively, like the mine is a hole in the ground with a
With
liar.
the liar at the top.
What if it's just somebody who's telling a great story and the story happens to be true or mostly true? Um, but it is something where you do have to communicate the difference between one hole and the next.
Well, but there's also, look, I mean, the way that when you look at these resource estimates, one of the things that's really common is, um, the what has to happen is there are the you drill and then you collect your core samples, and then you have to extrapolate from those samples, what type of deposits you have, and what the mineralization is, et cetera. And there's a common technique called smearing in your when you do your block model. And I mean, at the end of the day, the geologist who does these resource estimates, it's a lot like accounting estimates. There's a lot of leeway in developing those block models. So if you know what you're doing, you can get inside the block model and figure out kind of where they're probably smearing things. And so people don't do that. Now, then you get this other element of sometimes you get this exquisite rock, like great, great deposit. The only problem is the project will never get done because it's in an environmentally sensitive area, or you have government that's not, that's not going to be cooperative, or the infrastructure spending is going to be so immense, it's going to take a long time to do it, and there's a lot of risk. So when you look at, say, Mayfair Gold, and caveat also, I'm now a director of Mayfair Gold. Darren McLean is the chairman and interim CEO of Mayfair Gold. But so we went alongside activists on Mayfair in June, and we replaced the previous board with over 91% of the votes for getting over 91% of the votes for each of the seats. But when you look at Mayfair, Mayfair is a really nice deposit. But what makes us so excited about it is that we don't see it having those challenges. It's located in Canada. It's just off a major east-west highway. It's near hydroelectric power. There's a lot of other infrastructure in the area that we can take advantage of. So from our perspective, you could show us a better piece of rock somewhere, but if you don't have all of these things lining up that make the project viable, then we're not interested.
I want to bring it back a little bit away from the thesis and into the business side of it. What about the break even point? What is the point that you need to get to consider that it's worth it to put in this effort and the headache of trying to do this? And what is sort of like, what do you need out of the gate from an initial, not a seed, but an anchor investor or a couple early investors? Or are you, really investing in this yourself with your personal capital, betting that over time you'll be able to show results and that the money will come?
So my answers to these questions are particular to me, and you have to go back to the history of, or how I've evolved this business. So again, I was okay with losing money 99 out of 100 days and then trying to make that money back on the 100th day. So I have, and a lot of people are amazed when I tell them this, but I have never run the management company at break even or profit. I've always lost money because I'm always outspending the management fee. That's because I view short activism. I mean, there's so much risk inherent in short activism that I spend a lot of money to try to make our unknown unknowns known to us. Other people in the space take a more disciplined approach financially, but for me, and this is where we go back to that whole point of I would have been better off doing pass-throughs, especially because on a couple $100 million of capital, the SEC limits more so than it used to what you can pass through. But basically certain research expenses, like when we're looking at on the short activist side, a company, we might be interested in a particular jurisdiction in which the company operates, and we want to make sure we're not missing anything. So we'll engage local counsel there, and I eat that. That comes out of my pocket. If we were doing the fee model we should have done, we would pass that through to the fund. When we hire investigators, all right, that comes out of my pocket. We should be passing it through to the fund. We have PR firms that help us communicate our message and help us work with the media to communicate our message. It comes out of my pocket. We should have passed that through. And from a research team perspective, we run big. I think that's what you have to do in short activism. Now, the economics of these other businesses there's not nearly as much legal risk,
Yep.
obviously. Um, and we're not all over the globe, the way we are short activism in terms of, things that we have to look at here. I mean, with resources and mining, you can be, but it's still more contained than a lot of the research we do in short activism. So, and we just don't need as many people in these other funds. So the break evens on those should be a lot lower than, I mean, like as I said, I've never seen break even on short activism. But right now, I mean, they were small funds launches, and we ended up changing the exemption for so basically, we manage private funds. That's what a hedge fund is. The SEC calls them private fund. It's not like we have a listed fund here where we file
Yeah.
the prospectus. So we're relying on certain exemptions. The short activist funds, the exemption upon which they rely from full registration with the SEC is because we only allow qualified purchasers. So those are individuals with minimum net worths of 5 million or more. We changed for the resources and the Vietnam Fund, we've changed the exemption so that we may accept money from accredited investors, which is million or more net worth or $200,000 in annual net income. So we're taking smaller tickets because those have been smaller launches. I've told the people involved in both of those funds, people in Vietnam, Darren and others involved in mining, I'm personally committed to funding these businesses till they get to where they need to be. The launch of the Vietnam Fund was substantially all internal money. Got a little bit of additional of outside money, but it's one of those things where we're just going to have to bootstrap it. We had a lot of interest from Asian family offices, but it's that chicken or egg thing where it's like, well, we want to see you launch the fund and then we'll allocate to it. With mining and resources, there's been somewhat more traction because those are somewhat hot areas and people are talking about them more now, especially if you think about copper and electrification and, and really the need for storage. So it's hard scrabble, but I'm committed to getting those things up and running. And, just like the other funds that we launched, because of our fee structure in the past, it took longer to raise money. We said no to people who wanted special terms. They wanted discounts or high watermarks or liquidity preferences, and they were willing to write big tickets, and we turned them down. Because we think that the right thing to do over the long term is just, like do the business. It should put up the numbers, and eventually the checks will come in.
So you talked a little bit about the 3C1 versus 3C7, which is the exemption about whether it's qualified purchasers or just accredited investors. What about the 506B versus 506C exemptions? I know most funds, what most people think about with private funds is the 506B exemption, which lets you market only to accredited investors. So somebody would have had to, whether it be they're introduced to you through a personal connection or they've come to your website and sent you an email saying, hey, I'm accredited, then you can start to send them your marketing materials. In 2012, with the Jobs Act, they put out a new exemption, the 506C, which allows investors to market their products more broadly, generally solicit to the broader public, but with the caveat that all purchasers must be accredited investors. Is that something that you explored with some of these newer launches?
The 506C exemption is exactly what we've done with Vietnam and mining. Although we didn't launch them that way, we converted them to 506C when it was clear that we weren't getting $10 million tickets. So yeah, I mean the difference is though when you're accepting qualified purchaser investments only, there isn't really that much of a diligence burden on us as managers to ensure that they are in fact qualified purchasers, right? They have to rep and warrant that they are qualified purchasers. And as long as they rep and warrant that, it's more or less, it's there's not a huge burden on us to make sure they're not, you know, misrepresenting. However, with 506C, accredited investor, even though it's a lower bar, there is a burden on us where we do require some documentation to establish that the person is indeed an accredited investor. So I guess the difference, not saying there isn't a burden on us with a qualified purchaser, but we don't need to, there's no burden on us to request and review documentation to establish qualified purchaser status. We may rely on the representation, whereas with accredited investors, there is more paperwork challenge, more taxation in the form of back office labor to ensure that they are actually accredited investors.
Those are things like tax returns, letter from a CPA,
Yes.
saying that they are accredited. It's interesting. The SEC lists things that are acceptable, but they don't list like this is what you must have. There are a couple of things that they give you an option for there. Um, and obviously, like the benefit of going that is the ability to market in public and to talk about the fund and the strategy a little bit more explicitly in the public eye. Are there certain things that I think it's helpful to talk about what something that maybe you couldn't do with the activist fund that you could do with the mining fund or the Vietnam fund?
Yeah, I mean, could talk performance numbers. Well, I mean, I can't even, my our GC gets on us. I mean, the joke is we can't use the F word when we're talking about those other funds. Like I haven't even mentioned the name of those funds, of the activist funds, the ones that are for qualified purchasers only. And if we weren't discussing the industry and the asset management industry, and if this weren't educational, I'd be even very reticent to talk about how these are funds as opposed to strategies. I mean, it's pretty asinine. Like that's one of the things that I've railed about internally when I get frustrated because our GC, like he's just trying to protect my ass, but he'll review one of our podcasts, and if I said, oh, the XYZ fund, and it's not a 506C fund, then he'll say, no, 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 you can't say fund, you have to call it strategy. So it's this stupid game that's played on Wall Street in the fund management industry where people use the S word instead of the F word. I mean, at the end of the day, it's totally asinine. And and then I'll look and see Kathy Wood was a fully registered fund, going out there and making projections or predictions as to how much that fund will be, the NAV will be in 3 or 5 years. And it's just like, really, I can't say the F word on TV, and she can go and tell you that she's going to quintuple, or she thinks she'll quintuple the NAV. Like, there's just so much regulatory bullshit in this industry. And that, Max, that's something we haven't touched on, but I mean, this is actually a major point, something I've been thinking about so much recently because, when I started, so Dodd-Frank required private fund managers who manage a combined total of 150 million in AUM to become fully registered with the SEC. Okay, so when you become fully registered with the SEC, you have to have a lot more. Your business becomes a lot more complex. Like we spend 6 figures a year on some outsourced IT company that puts their software on our computers, which makes our computers less reliable. And but at the end of the year, or at the end of the day, it's a tax. We have all of these legal and compliance related expenses that are taxes. We take all this time internally to do this shit, and $150 million back then in January 1st of 2011. Well, if you look at where the S&P is today, the equivalent amount of money would be almost 800 million in AUM. And, but that threshold has remained unchanged. I mean, you are a nothing in the asset management business at 150 million of AUM.
You can't win institutional investors emerging manager award unless you have 300 million. And that's for their emerging manager, but you're not even on the radar of institutional investor until you hit 300 million.
Right. Well, although we were nominated for an Activist of the Year award, like it was like our worst year to date. So that was in 23. I thought it was a joke, actually. I'm like, really? It's like the worst fucking performance we've ever had. Why are
Well,
you
thank your
nominating us
LP who
now?
put you up for the award.
Yeah, right. But all the awards that year went to funds who had sponsored the event, like Saba and I forget the other one who was a big
Well,
sponsor of the
even if
awards.
you
But
won the award, you couldn't do anything with it in marketing. You would have to disclaim that awards mean nothing and that you can't do anything with the award anyway. So,
right,
yeah, couldn't put it on your
exactly.
website. So, yeah, it's a great award that you can do nothing with.
Exactly. But to also give you a sense of, so you've had the inflation in, AUM and, 150 million now or back then would be equivalent to 800 million now. But also think about the cost side. I mean, how much more are we paying for all of these compliance services? To give you one indicator, okay, back in 2012, I had to engage my first big firm regulatory attorney. There was an investigation. Like I wasn't a subject of the investigation, but I got hit with a subpoena into this one Canadian U.S. dual listed China scam called Silver Corp. And so I'm like, all right, well, time to be, I've got some money now. Time to, go in with big boy counsel. So I engaged this one attorney, but he billed at 1,200 an hour, and I almost fell out of my chair when I heard that. I'm like, Jesus Christ, 1,200 an hour, bro. When I talk to you, I better be getting some of the most profound fucking wisdom I've ever received in my life. Well, I got to tell you now, the $1,200 an hour attorney is $2,500 an hour now. All right, like there's been tremendous inflation in all these costs, but you know what? The SEC likes that because the SEC now loves coming in and basically having managers run these calculations of like, oh shit, well they're offering to settle like a books and records thing with me for 1 million, and fuck, if I fought it, it'd probably be 2 million. All right, like I'll take it. Right. So from the SEC's perspective, it's great. Um, if they, like I view when it comes to asset management, I do view the SEC as a bully now. A lot of rules have been promulgated the past several years. I think that they are solutions in search of problems. I think the problem is that when a lot of these people who work at the SEC, especially in the policy making positions, I think they wake up every day saying like, like what's something that could be wrong there? What's a dial I could turn or a switch I could flip? And they don't understand what the impacts are. Or when they think about the impacts, they're like, Ken Griffin's got enough money. It doesn't matter. He'll just have to, hire somebody else and do that.
33,000 hedge funds out there, 33,000.
Yeah,
Most of them
but
are not
right. In the
Ken Griffin.
vast, and you know where else, and I suspect, and I want to, look, it's in my head to do some research on this to try to build this out. But here's my feeling. Obviously, large caps have outperformed small caps significantly over the past blah years. I think a lot of that is passive, or it's related to flows and passive investing, popularity of the S&P 500 index funds. But the thing is, it's when when you're Tiger Global or you have that much in AUM, it's not worth it for you to have people looking at small caps and micro caps, right? Because it's not going to solve your allocation problems. Like you have too much money to allocate. So what this does is by making it more difficult, more expensive, ergo more difficult for small managers to be in business, I think that takes a lot of I think that harms significantly small cap and micro cap stocks because you don't have an institutional base out there, or it's a withered institutional base that can analyze those things. So I think that's bad for the market. And I think it's bad for the economy. Now, what's kind of become the band-aid is the pod shop. So all these guys who run these strategies that are subscale, they go to work for these pod shops, and okay, they can put risk on that way, and best in class risk controls. But these are monolithic corporate shitty cultures, I would imagine, for the most part. the opposite of what I have here, like not fun places to work, probably don't reward creativity much. Um, it's not good for the industry. And I think it's not good for the market. It's not good for the economy. And so there are multiple reasons for the problems that small managers face, but the SEC needs to, do its part by taking its foot off the throat of small managers. And I mean, well, this is really Congress's call here to raise that 150 million, registration mandate, and index it to something, please. Um, but yeah, I really think I really think that these are significant issues, especially with the SEC's view of its books and records. It's such an expansive view of what that covers now. So that means you've got to archive everything, which costs money. When you get a subpoena, now you have all this shit that you have to send over to your lawyers that they charge you for to review. So it becomes really burdensome. And then this whole cybersecurity guidance. I mean, that's the reason we have these outsourced IT firms. Well, it's only guidance, but everybody tells me that they expect the SEC to actually codify it at some point. So, we need to keep we need to keep our agreement with an outsourced IT provider. But like I said, that's a stupid tax and it makes my computers less reliable because at any time in our firm, there's at least one person who can't send a fucking attachment because their computer's dicked up by the software they put on it.
Tell me how you really feel. No, but I mean, politically, how like we talked about the 506c exemption, and if you read about why that was done, it was to help the industry in the wake of the financial crisis because finance had been hurt, reasonably so. But it was put into like the Jobs Act. Like they're not going to pass a specific law that raises this. It's going to have to be something that gets tacked on to something else.
Well, they can amend Dodd-Frank, right? I
Okay.
mean, or somehow. I mean, and look, every law that comes out of Congress, it's ostensibly for this, but it's got 600 other, like provisions or things that it does. I mean, I don't know if it's that nobody's really brought it to anybody's attention in Congress, but at this point, who's going to do it? I mean, there are one or two hedge fund trade groups, but I mean, they're not representing for the most part the small asset managers. They're representing the citadels. Like those, and so, Ken Griffin's not going to shed a tear, doesn't give a fuck. And it's
Fact,
good
it
for his business.
probably benefits him, less competition out there. Yeah.
Hmm.
So
More people to come into the pod shop.
yes. All right. Well, look, Carson, there are plenty of things for next time. We didn't talk at all about hiring talent, your decision to move from California to Texas. So there's plenty for us to touch on the next time you come on. But thank you so much for being the first guest on Other People's Money, talking to us a little bit about what it's like to be on the inside as a fund manager and a founder of a hedge fund business.
All right. Thanks, Max. It was great to have this conversation. I haven't had this before, in any medium other than in person, just bitching to the people around me. So, yeah, I enjoyed it. Hope it's useful, and best of luck with your new podcast.
Yeah, I mean, the idea is that it probably will be useful, maybe not as useful to all of the people who are looking for the next hot stock in their podcasts, but that there's plenty of people out there, whether they're aspiring fund managers, active fund managers, or people in the business in some other capacity who'd find this type of content useful. And that's a good opportunity for us to do the disclaimer here. There are many things that we talked about that were relevant to Carson's business, but this was purely meant for educational purposes, informational purposes, to talk about this industry that is very, very difficult to talk about in any sort of open and honest way, for many good reasons, but some of them maybe not so good. So thank you, Carson, and thank you to everybody for listening.
Thanks, Max.